Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, May 2nd, 2021. We've got another great show for this week. I'll be joined by members of the media, academia, and financial services as we analyze all the news and information in retirement markets, technology, personal finance, so much more. We've got another great show, so sit back, relax, and enjoy this episode of BRN Sunday. Well, let's kick things off with a little bit different order this week. And joining me on the line, they're better known as the Legal Eagles. Let's welcome to the program David Levine, Kevin Walsh. Both are principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, how are you this week?
Well, we're really excited. I don't think we've ever led the show before, so thanks for having us on. And listeners, if we assume you've always made it to the end, but if you haven't, it's great talking to you today.
Well, it is great talking with you guys, and I think this is an important topic, David. We're going to talk a little about 403Bs and collective investment trusts. It seems like this has popped back up on the legislative agenda. What can you tell us?
Sure, absolutely, Jeff. And I will say thank you for including us to talk in media speak in the A block. I can't tell you how proud we are that we finally made it to the A block. But we're going to talk about 403Bs and CITs. I think here's the key thing. Over the years, or, since it's right after the State of the Union, here's the deal. Right after the State of the Union, it's important to sound like Joe Biden. That's why I did that, if people don't get it. Historically, people think of retirement plans for people as 401k plans. And, these account-based plans that most Americans with larger employers have at this point. But there are other types of plans that look and smell like 401k plans, but aren't. These are so-called 403b plans, which long predate 401k plans and have been around in the educational and nonprofit sector for a very, very long time. Mm-hmm. And then there's also 457b plans, which are kind of the 401k of the governmental plan for like government entities that have defined contribution plans. So why do I say all that? Well, because out of the box, everybody thinks, oh, all these plans are subject to the same rules. And the simple answer is they're not. We can spend a lot of time on the big distinction, Jeff, is that 401k plans can invest in an extremely wide universe of investments. And you can have self-directed brokerages with individual stocks, you can have company stocks, you can have mutual funds and collective investment trusts, etc. Over the past decade, you've seen a real rise in the use across plans of all sizes of collective investment trusts. What are these? These are basically trustee buckets of money that look like a mutual fund, smell like a mutual fund, but they have a different regulator, the Office of the Comptroller of the Currency or state banking regulators, than like the SEC for mutual funds. Mm-hmm. But for operational purposes, they're traded and feel pretty much the same. We can get into the details. The key thing that people talk about these is the cost of these investments, often for regulatory compliance reasons, are cheaper than the cost of mutual funds, although not always, but sometimes they are. And anybody who says always, you should always run. In this world, nothing is always.
Yeah, that's true.
So always run, though. Always run. Hear David's advice, always run.
Touche, I deserve that, Kevin. But if you look at 403Bs, 401ks and 457 plans have for a long time been allowed to invest in this wide universe. 403Bs, though, because they're an older type of vehicle, generally have required, there are some exceptions, but it's not the vast majority, have required the investment of funds into annuity contracts, okay, so like annuities, and or custodial accounts in English, basically into accounts that you could invest in things like mutual funds, but not collective investment trusts. But with this giant move towards collective investment trusts we've seen, as I've said, it's not everything, but we've seen a big move. What's happened is that there's been a lot of questions of, especially with fee litigation and 403Bs, why can't they get CITs? And the industry has come out in support of this pretty widely, and there's been legislation introduced. We've been involved in it. And the idea is to change the 403B rules, put very simply, to allow 403B plans to invest in collective investment trusts. It pops up occasionally as standalone legislation. It pops up in big consolidated things like Secure 2.0 type of discussions.
Mm-hmm.
It is very likely going to be part of the next big secure type package. It's just a matter of when. And as you know from our segments, and for the listeners who've been kind enough to stick around to the end in the past, we could spend years talking about potential legislation, but it will pass at some point. And that's a big deal because it'll provide some more harmonization on investments and potentially lower costs. Mr. Walsh, what do you think?
So, David, is the issue here really that, 403B plans really predate a lot of the innovation we've seen in the, individual account style retirement space?
They do. They were the innovators of their time, but 401ks have gotten more attention since.
Kevin, did we lose you?
No, I'm here. I thought David was going to say more. I was disappointed he agreed with me.
Yes, and for the listeners who's never heard us, we usually have this banter, and Kevin just conceded. Kevin, don't freeze up on the A block, please.
I dropped the ball there, guys. Yeah. So, but I think the key here is that we both think that innovation's coming in the 403B space, which is probably a good thing because I think it's going to be interesting to see if the expansion of collective investment trusts into these additional types of plans leads to more consolidation in a way that can drive down fees.
Yeah, I in my mind, having worked with 403, 401, and 457 plans, this one's long overdue, gentlemen. I'm really excited. I'm glad that Representative Panetta reintroduced this bill, and I'm actually really looking forward to see how things progress about inclusion of this and other components are wrapped into new legislation. Gentlemen, we're going to leave it there. Always a pleasure chatting with you, and we love having you in the A block. We just try to rotate for the benefit of the audience, just try to rotate people in. You guys do a great job. Really appreciate your contribution to the network. Enjoy your weekend, and we'll talk to you again very soon.
Have a great weekend, Jeff. Thank you, listeners.
Thank you so much for your time.
Bye, guys. Bye-bye. Welcome back. Now, time to talk a little personal finance. Joining us on the line, she's a personal finance reporter for The Motley Fool. Welcome back to the program, Mari Backman. Mari, so great to have you back, and thanks so much for joining us this morning.
Thanks for having me.
Yeah, and I know you wanted to talk tax tips. We're, about 17 days away. By the time this airs, it'll be the 2nd of May, so almost 15 days till the new deadline. So tell us, what are some things we should be thinking about as we're getting ready to file our taxes, if we haven't done so yet?
Yeah, we're getting into that final stretch, Jeff. And, what's funny is since, people are going to be hearing this about 2 weeks away from the deadline, one of the most important things I always like to tell people is start your taxes if you haven't started already. Don't wait till the last minute because whether you're doing them with the help of a professional or you're doing them on your own, the reality is as you're going through those forms, questions could come up, things could come up, and you don't want to feel stressed that you don't have enough time to get the right answer, right? Because then what happens is you'll either make a mistake, which could cause you problems, or you might miss out on some tax breaks that you may be entitled to. So, for example, let's say, there's a tax credit and you're not sure if you're eligible to claim it, and you've waited till the day before your taxes are due to kind of look at the forms and everything. Well, that doesn't give you very much time to dig into it, so you might just say, okay, well, gosh, I'm not going to claim this now because I don't want to do the wrong thing and get in trouble. But maybe you could have gotten a tax credit that could have actually saved you thousands of dollars. So my number one tip is always don't leave it to the very last minute.
Yeah, well, I think that just, especially given what's happened with this pandemic, some of the delays that obviously we have with the IRS and some of the states, and also considering that if you receive some type of support, unemployment support from both the federal and state government, you need to make sure that you have your 1099s and that, depending on where you live, and I think this is the case in most states, that is not being taxable. But look, the last thing you want to be doing to get it right, you don't want to be rushing around, Mari, at the last minute because you're just going to make mistakes, and that's not a good thing.
No, not at all. And then the other thing too, so you've got a lot of people these days do file taxes electronically. I mean, that's what all the, I shouldn't say all, but typically the tax preparers do and everything, and a lot of individuals who do their taxes, they file electronically. But there are those people, Jeff, who like to, just keep it old school and do those, paper returns where you actually sit there filling out a form. And I definitely don't recommend that. In general, I don't recommend that, but I don't recommend it this year in particular. So I don't recommend it under normal circumstances for a couple of reasons. First of all, you're more likely to make a mistake if you're doing your taxes by hand. If you're doing it electronically, even things like math errors, you're less likely to make. And also, these electronic programs, they sort of like prompt you to do the right thing, if you will. So that you're less likely to make an error that causes any sort of delay in processing your return. And seeing as how the majority of people who file a tax return every year get a refund, you don't really want a delay. So that's number one. But number two, even under normal circumstances, refunds for paper returns, they take about twice as long, Jeff, to come in as refunds for electronic returns. So that with an electronic return, you're looking at, a refund usually within 3 weeks, assuming there's no problem with your taxes. Whereas for, paper, it could be 6 to 8 weeks. So if you're due money back from the IRS, you don't really want to let them hang on to it for longer, considering that a refund already means that the government was hanging on to your money for longer than it should have been. So, that's just something to keep in mind in general. But this year in particular, you really don't want to file on paper because the IRS is very, very backlogged in processing returns. The IRS also has a lot on its plate right now. It's been issuing stimulus checks. It may not have full staff in the office because of, the pandemic and whatnot. So it may be short-staffed in, having people there to physically open those paper returns and go through them. So for a lot of reasons, this just really is not the year to file on paper.
Yeah, you made a really good point, and I just want to reiterate that when you get a refund, and I don't think a lot of people think about this, they feel like you're getting money back, but it's really an interest-free loan to the federal government or the state government, right? And you're basically letting them use your money that was owed back to you look, granted, there's not very high interest rates, but that's money that you could put to good work for yourself, whether it's paying off bills, debt, savings. That's a good thing as well. So you certainly don't want to, misdirect or not take advantage of that. And then, Mari, in terms of making the payment, say you have to make a payment, is it a good rule of thumb? Number one, can you make those payments online to state, local government, and federal government? And two, if you have to write a check, do you do it return receipt requested so that you get acknowledgement that it was post-dated correctly and someone actually gets it?
You can definitely send those payments online. You can arrange to have them just taken out of your bank account. That's how you would usually set it up if you're doing an electronic return, and that definitely to me always just makes the most sense because it's easy. You're not putting something in the mail, and then you just see that money come right out of your account, so you don't have to sit there questioning, did it go through or not? You just see that it's there. But if you're going to mail something in, you definitely want some sort of return receipt to make sure it was received. I recommend the same thing with your actual tax form itself. If you're sending in a paper tax return, you want some sort of acknowledgement that it was received. One way you do not usually want to pay a tax bill is via a credit card. It is an option, but there will be processing fees and other fees that you're going to pay just for using a card. So I definitely recommend not doing that if you cannot pay your entire tax bill at once, because some people say, all right, well, I'm going to put it on my credit card because let's say I owe the IRS $2,000. I don't have $2,000, but I've got, that much of a credit limit, so I guess I'll put it on my credit card and then I'll pay off my credit card over time. The thing is, your credit card is going to charge you a lot of interest to pay off that bill over time, plus the IRS is going to charge you some sort of processing fee just for using a credit card. If you can't pay your whole tax bill, the IRS will work with you. You can set up what's called an installment agreement with the IRS, which will allow you to pay off your tax bill over time. And yes, you'll still incur, the interest and penalties that come with owing money and not paying in full. But as long as you follow the terms of that installment agreement, you'll be considered current on your tax bill, which means the IRS won't try to garnish your wages or anything like that. Like if you if you owe the IRS money and it's going to take you, I'm just making this up, 24 months to pay it off, so month 2 into that agreement, you're obviously not very far into your debt. You're still considered current, though, as long as you're following the terms of your agreement. So for those 2 years, it's not like you have to worry about your wages being garnished as long as you're making your payments. So an IRS installment agreement is definitely the better choice if you owe money, because your credit card is going to charge you a lot more interest than the IRS is going to charge you.
I guess last question here, Maury. By the way, I heard your dog second that. I heard him or her second that. Really good. See, you heard it from the canine. Last question, Maury. Let's start thinking about taxes for next year and things that you could be doing once you get through the 2020 tax. Things that you can be doing to get yourself set up in a better position for 2021 tax hit filing.
Well, actually, what's really interesting? So my top tip for that, Jeff, is to say, put as much money into a tax-advantaged retirement plan as you can. So if you have a 401k, the more money you put into that plan up to the annual limit, the more income you can shield from taxes. Same thing with an IRA. But what's actually interesting is that if you're saving in an IRA, and if you did not yet max out your 2020 IRA, you actually can still sneak some money into it this year. You have until the tax filing deadline, which is now May 17th, to fund last year's IRA. So let's say, you're under 50. That means that your annual contribution limit is $6,000. Let's say you only put $2,000 into your 2020 IRA, and you're doing your taxes now, and you're like, oh, yuck, I owe the IRS $600. Well, wait a minute. If you have the option to actually go back in and put more money into last year's IRA, you'll be paying yourself, you'll be padding your own savings, and then you might wipe out that tax liability. So it's actually not too late to do that even for last year in terms of an IRA. You can't go back to your 401k, but you can go back to an IRA. But otherwise, looking forward, to this year's taxes, definitely try to get as close as possible to maxing out one of those retirement plans, because that'll save you a lot of money on taxes. And then the other thing, too, is that, if you itemize on your tax return, definitely keep just good receipts of things like charitable donations. If you donate, let's say, a pile of goods, maybe old furniture, old toys, old clothing, keep those receipts, because that could serve as a deduction. Keep good records of your medical bills, because if your medical expenses exceed a certain amount of your income, that may be a deduction. So just keep, max out those retirement plans, keep really good records, and I also be strategic about selling investments, Jeff. If you have money invested in a traditional brokerage account, if you hold your investments for at least a year and a day before selling them at a profit, you won't trigger as high a tax bill for your capital gains. Now, I know a lot of people, they may not be thinking of that. A lot of people are, a little more focused on, putting money into their savings account and paying off debt, and they're not necessarily getting into investing yet. But there are plenty of people out there, who do have investment accounts, and, they open up these brokerage accounts, and they don't realize that selling at the wrong time could actually trigger higher taxes. So you want to keep that year and a day rule in mind as well.
Very good ideas, as always, Maury, and people can certainly check out more. She writes regularly. I know she just wrote a story on tax tips and a lot more. Maury Backman, always a pleasure chatting with you. I want to wish you a wonderful rest of your weekend, and we'll talk to you again very soon.
Sounds good.
Bye-bye. Welcome back. Now time to talk markets. Joining us on the line, he is the lead anchor for the TD Ameritrade Network. You can catch him on Morning Trade Live and Markets on Close. I'm talking about Mr. Oliver J. Rennick. Ollie, great to talk to you. Thanks so much for joining us this morning.
Thank you very much, Jeff. Pretty interesting week here for markets.
Yeah, absolutely. And I should just preface this that we are talking on a Thursday. It's afternoon here on the East Coast, but Oliver's in Chicago, so he's still in the morning time. So there's still one more day of trading, but Oliver is taking the day off, so we wanted to catch him before he jets out. So Oliver, interesting week of trading. We had the president's, I don't know if that was the State of the Union address or what that was supposed to be. The Federal Reserve comes out. Give us your take. What do you see in these crazy markets?
I mean, just a really pivotal week The reason that this is such a big week, to your point, is we've got everything. We got the most dovish Fed in history. We got a president that is going to spend more money than any president has. I don't know. I'm not the historian, but it's a lot. Okay.
Yeah, it is.
At the same time, we've got the best earnings we've ever seen for the biggest and most important tech companies in the market in the world, frankly. And how we respond to that, oh, by the way, a GDP of 6.5%. We've got all of this, and as we speak right now on Thursday, the market is actually down on the day. And you look at that, and it's a small move, and we are sitting near all-time records. We made a record earlier this morning on the intraday chart for the NASDAQ and the S&P 500, but yet we're pulling back. So you can basically view this as one of two ways. You can view this as, well, we're already at highs, markets are healthy, don't bet against markets that are making highs, or you can view this as some combination of fundamentals and technical price action, where I generally operate under the kind of market philosophy that when things go against what you suspect to be a fundamentally driven direction, then that signals the power behind the trade in that direction has to be respected. So, for example, if a company like Apple gives extraordinary earnings and the stock goes down, then that means there is some impulse in that moment that is very strong in terms of that kind of selling pressure. So you can write off these moments as these quote-unquote sell the news moments or profit-taking moments. And while that very much may be true, it gets a little bit more complicated when there is such a pile of profits that could be taken in the market that has been rallying the way it is, meaning that if it looks like these companies are showing growth that is so extraordinary that it's going to be hard to live up to in the future, like is arguable for Apple in their device sales, then why wouldn't you take profits if you've been in the stock for so long? And if people get that idea at the same time, then that's kind of the behavior that you need to be wary of when we're at all-time record valuations in the stock market, above dot-com levels by many measures. You have to be very, I think, hyper-aware to the possibility that things can slow down and roll over without any good reason to, basically, without any bad news, without any negativity, really, just sort of an exhaustion. And that is what I fear we're kind of going through right now, and why I've covered the market quite cautiously, even though we've been making new highs in the S&P 500. Because the complication of this growth right now is that the market loved an environment without any growth. I mean, it's just the bottom line. You had all these big tech companies that had growth going up, sales going up, while the economic growth went down during COVID. And that spread between the company growth and the economic growth was so hugely advantageous for these tech businesses that they achieved very lofty valuations and price levels. But as the economy comes back to normal and their growth levels go down, as that growth spread contracts, that should be quite negative for the valuation of these companies. So we have this battle that's happening where the fundamental reopening of the economy is very good, but it's creating a lot of complications. And as we see yields move higher, that's kind of chipping away at these tech valuations. And it's a bit shocking to see that we're putting so much into the system and right now getting kind of marginal gains.
Now, Oliver, I guess, obviously you follow the market day to day, week to week, minute to minute. But let's talk about the long-term investor as well, because we're going to be using our phones. We're going to be maybe using our tablets, our devices. Technology is not going away. It may be as we return to normalcy. And you may be right, people may be profit-taking or whatever the right terminology is, setting things backwards. But let's give the longer-term perspective. I mean, we're not going back into hibernation here, right? Things are not going to, the new normal isn't, we're all in the office together. The new normal could be partial days, hybrid type of work. So technology still has a big fundamental role to play, but we could see things in the short. And I'm not saying this is going to happen, but you could see things kind of back off in the short runs. I think, which I think is what you're suggesting. But longer term, the play is there for technology and for those supporting businesses that support around technology, that nibble around the technology sector.
It's all a push and pull between bottom line earnings growth and the valuation contraction. And that's a point that will only be understood as time develops. This is where, I'm applying a sort of fundamental perspective here that says, well, the economic growth relative to the company growth is going to be impossible to match in favor of tech as it was during COVID. So as the economy reopens, those valuations are going to contract. That's kind of a fundamental view. But technically, this is why one has to respect price action is, well, we're going to find out because their earnings are going up, right? And as the economy goes up, the S&P 500 earnings will go up. But given how high valuations are, if the earnings are not able to offset the valuation contraction, then all these things can be true about the business growing, but the stock price can actually go down. And we just have to monitor what the price action and what the technicals in the charts tell us. Because if the charts start turning around as the fundamentals are improving, and we should assume the fundamentals are going to keep improving, then we should probably assume the price is going to keep going down. And it sounds very backward, but we have to remember that we just had one of the best stock market runs ever, the best stock market run in terms of valuations during one of the worst economic periods in history. So why shouldn't we then have the stock market go down as the economy gets better?
Yeah, I mean, you're right. It is kind of very counterintuitive. I guess two last questions for you. I'll ask them one at a time. Let's talk about housing for a second, because from what I understand in talking with people in the housing marketplace is that it's hard to get lumber. It's hard to get microchips for your appliances. Any sense for how this has an impact on some of those home building organizations? I mean, I would imagine it has a significant impact, but talking about REITs, talking about real estate rentals, all those kind of things. How does that play out in the market?
Right now, there is such overwhelming demand for these homes that the home builders are doing great. It's pretty amazing. I mean, prices of inputs, prices for lumber just going through the roof, but there's just no pun intended, but there's just so much demand demographically for housing that it's offsetting all of that, and home builders keep making new highs. So eventually you would think that it'll get more difficult for these companies, but there's just no evidence of it slowing down yet. Again, this is a place where I just kind of have to watch the price action, what the market is telling us, because I have no special insight into housing or the strength of the consumer. It seems like obviously people have a lot of money to spend right now, and that's true. There's some demographic tailwinds for housing, and all of that is just right now too strong to be offset by the price of some of these commodities. As far as the home builders are concerned, they're still making money on these homes. They can't build them fast enough.
No, they can't. I mean, talking to Jacob Passy over at MarketWatch, there's a 4 million home spread between the demand versus what the supply is. Last question, Oliver. Kind of along the same lines with cars, gasoline. We've seen gasoline prices kind of tick back up, I guess, as people have begun taking back onto the road. We're coming up to the summer months. After Labor Day, typically gas prices go up. Any sense for what's your perspective, I guess, on the auto industry, the auto suppliers? We're seeing chip concerns there, semiconductor concerns there. Any thoughts about that particular market, and in particular the commodity of gasoline and oil?
Yeah, well, right now it seems to suggest that there is real evidence of recovery happening. If there's any doubt about the sustainability of it, crude oil, which has been moving higher, and gas prices, which have been moving higher, suggest that there is a lot of sustainability to our recovery. Crude oil over the past 3 months has been flirting with a decade-long breakout on the chart. Crude oil has been trending lower for a very long time. You can draw a straight line down from crude oil back to 2008. So that's a 13-year downtrend line that's been breaking on the chart. and looks to be breaking more as we speak this week. So crude stabilizing at 60 and rallying puts a lot of things on the table for potentially $70, $80 WTI, and that's the type of thing that many people thought we'd never really see again after the past year. So that tells us the recovery is very, very real.
Yeah, and especially given the focus on ESG, sustainability, net carbon tax, and all those other concepts. Well, Oliver, we're going to leave it.
Doing it despite all that.
Yeah, it's amazing. There's kind of like that headwind. Probably a longer conversation for a later day. Oliver's got one more show to do. Oliver, we thank you very much for making an appearance and wish you a nice trip and a great weekend. Thanks, buddy.
Okay, thank you. Bye.
Welcome back. Now time to talk technology. Joining us on the line, he's lead advisor, executive producer for 7 Investing. We're talking about Daniel Klein. Dan, great to have you back on the program. Thanks so much for joining us this morning.
A happy morning it is, Jeff. Thanks for having me.
Yeah, I hope you're enjoying the weather. What's the weather like in West Palm?
It is 88 and oppressive. Like it basically feels like a large person is sitting on your chest when you're outside. The humidity is palpable at the moment, but there's going to be a lot of pool time this weekend, I think.
Yeah, and are you still doing your outdoor exercise regime, or is it moved indoors?
So I meet with my trainer 3 times a week inside at the gym. We have a beautifully revamped gym here that almost nobody uses. And yeah, some days I have shifted my long walk outside. Some days I'm doing that on the treadmill. If I can't do it early in the morning or sort of at dusk, it is really hot out. So I have been sort of careful to take it inside to the treadmill or the rowing machine.
Well, good. Stay, keep going, but take the appropriate measures. All right, Dan. I love talking to you about so many things around tech. We've got 2 great stories. There's so many. The first one, Amazon. Amazon may exceed Walmart in retail sales, but I think 2025, according to one report. Thoughts there? This is kind of the survival of the fittest now, right?
So I think the way this was framed in this article was a little bit wrong because, yes, this will happen, but it's not like it's because Walmart isn't growing too. It's just because Amazon and Walmart are just crushing most competitors. I say most competitors because Best Buy is doing well. Dick's Sporting Goods is doing well. Here in Florida, there's a lot of loyalty to Publix. Mm-hmm. Kroger during the pandemic is doing well. I worry about them because I don't think they have that loyalty. And I think post-pandemic, they are very vulnerable to Walmart and Amazon just pricing them out of existence because they don't need to make money on groceries. But we were talking about this on our 7 Investing Slack that, did Amazon have a blueprint for this? And obviously Jeff Bezos is a visionary, but you can't tell me that when he opened an online bookstore, whenever it was 20 years ago, that he went, yeah, someday when we launch our chain of 3,000 grocery stores, in addition to the 600 luxury grocery stores we bought in Whole Foods, we'll be bigger than Walmart. His vision back then was probably like, yeah, we'll add CDs and maybe posters. And the fact that the digital end of Amazon is a dominant player. AWS is the market setter when it comes to the cloud. And, people talk a lot about how bad Amazon has been for small business. And sure, if you have an undifferentiated small business without really good customer service, Amazon put you out of business. But how many business has Amazon enabled by making the cloud and computing power essentially free? Back in the 2000s, when I was working at websites, the early 2000s, computing was a massive expense. You had $3,000 servers and you had to add them when your audience grew. And there was no easy way, if you had a spike in interest, there was no easy way to scale up. The cloud makes all of that possible. I know I'm going off on a tangent here, but Amazon has really grown every aspect of the business. And I don't like, the Amazon tries to pretend that Jeff Bezos is always day one, is about always remaining, visionary. I think you can always remain visionary and stop treating your workers like they work in a startup. I think that's, a startup.
That's visionary. That's visionary.
Yeah, a startup mentality is great for a year, but there's an awful lot of really smart people who work at Amazon because it pays really well that aren't all that happy. And that's not universally true. I know lots of Amazon employees who love it there, and certainly in the remote world, it's gotten better. but I am critical of parts of Amazon. But the fact is, they keep innovating. I've talked a lot about how I think Amazon and Apple have a huge opportunity in healthcare, that you're starting to see Amazon spread out its employee healthcare program to other companies, and their wearable device that you can keep on for multiple days that, tracks all sorts of things, like, the salinity of your sweat. I'm not sure it does that, but like all sorts of, different health metrics. I do think, like, I don't want to say we've just scratched the surface for Amazon, but, top market cap companies, and we're about to talk about the top market cap company, Apple. It wasn't that long ago that ExxonMobil was the biggest company at like 700 billion in value. I forget the exact number. And now you have Apple over 2 trillion. You have Microsoft going over 2 trillion soon, if it hasn't happened already today. And Amazon will get there. And it's not crazy to think that 5 years from now, we won't be looking at 4 trillion as a crazy number. So I think there's all sorts of room for Amazon. There's obviously some regulatory hurdles that they might come up against in certain areas. But in terms of retailing, I think there's a lot of optionality, because right now Amazon owns a ton of brands. I'm sure you've bought Amazon Basics cables, and that line has worked. A lot of their retail lines have not sold well, because I don't know too many people who are buying, underwear sight unseen, or even like a sweatshirt. When they open up this chain of grocery stores, maybe they'll have some merchandise displays, not with the idea that you're going to buy it there, but the idea that you're going to see what it looks like they used to do in some of the Whole Foods locations, where there'd just be like a little display of Kindles and things like that. So I think there's all sorts of ways for Amazon to keep growing, but Walmart is no slouch. Walmart has done a really good job during the pandemic in learning that customers prefer curbside pickup to having to go inside a store and use a kiosk. Their kiosks were very innovative, but once customers got curbside as an option, they stopped using them. And Walmart has been aggressive enough to say, okay, this is what customers want. Let's roll back the kiosks. Let's give the people what they want. So you don't think of Walmart as a tech company, but the fact that they've gone to 2-day, in some cases same day, and certainly the ability to order and pick up in the store, they've been spending billions of dollars in technology, and they might not be neck and neck with Amazon, but they're doing a very good job as well.
Dan, before we shift gears, when you were talking, I was thinking about anybody who follows Star Wars and thinking that George Lucas had this all mapped out 1 through 9, or at least 1 through 6 before he sold the company. I think that's not true. So
I think that's 100% not true.
Yeah. If you go back to between episode 1 and 2, and then Luke was his father. We're going on a crazy tangent, but go ahead, finish your thought.
Yeah, Darth Vader was clearly his name at first, not his title. There were all sorts of things. There's scripts out there for if Star Wars hadn't done as well, what would the cheapo sequel have looked like if they couldn't spend the money they did on Empire? I'll give a shout out. My friend Kristen Baver is an associate editor at StarWars.com, and she just has her first book out on the Skywalker family, and she's brilliant. So if you're a Star Wars fan, go pick up A Family at War.
So that's a biography. Okay, Dan, let's talk about Apple earnings. Apple, I think, had its best quarter in a non-holiday quarter. Amazing.
Yeah, so look, you can get the numbers anywhere, but let me give you some analysis here.
Yep.
We're in a super cycle for the iPhone. You never sort of know when a new iPhone comes out if this is the one that like the people who only upgrade every 2 to 4 years are going to get, and that's clearly been the case with the iPhone 12 because of 5G. 5G is still sort of not everywhere. Like I have it in parts of West Palm, and it is very, very efficient in terms of like streaming a movie, which is not something I ever do in a parking lot. But I have tested it out. It does work well. That was a driver. So that's kind of just something that happens to Apple every third year. I almost throw that out. What I think is really interesting about Apple is they have talked for years about growing their service revenue. And for 2 straight quarters, they have grown their service revenue over 20%. Why is that important? Because at times in Apple's history, the iPhone has been 70+% of its revenue. If you grow service revenue, that's more predictable. So when I say service, that is things like the Apple subscriptions. If you get the fitness subscription, or I pay for the bundle that gives me Apple News, because I read a lot of magazines on my phone now. It gives me Apple Music. That is how my family chooses to listen to music, actually on our Amazon devices. And I think I get one or two other things. Apple TV, which I never watch. But the more of that revenue they have, instead of Apple being a hardware company that's somewhat cyclical, it makes Apple, at least partly, a software as a service company where you have these predictable monthly revenues and you start to see what your drop-off patterns are, what your retention rates are. And that's a very, very efficient, predictable business. And now Apple is to the point that they're still investing very, very heavily in their future, but they also just announced a $90 billion share buyback program. Most companies, I'm not in favor of share buyback, because if you're like Netflix is buying back shares, and in my opinion, Netflix has a lot they could do to be more efficient in what content they create. And I think they need to be working on that, not giving money back. In Apple's case, they're clearly spending on innovation. And when you buy back shares, that tends to benefit the stock price because there's less shares available. And more importantly, not that this is very likely, but if Apple needed to buy something, they have a massive amount of cash on hand, but the more stock they take off the table gives them the more optionality to do stock-based acquisitions. And I don't know what Apple would buy. My thought would be Spotify, because I don't think Spotify is a great business, and it makes more sense under the I don't think that'll ever happen. But that being said, I love what they're doing, but I'm not all that concerned on the fact that iMac and iPad sales are up. A lot of that is clearly due to the fact that we're all stuck at home during a pandemic, and kids needed devices and parents needed backup devices. So you will see, let's call it, pull it ahead quarter, where in a quarter or two from now, sales are year over year down in those categories, and it doesn't matter. Apple is a company that you really have to pull out and look at on a multi-year basis, not on a quarter-by-quarter basis. But these numbers were astounding, and of course, as the stock market logic is, Apple shares were down last I looked, because short-term the market never makes any sense.
No, it doesn't make any sense at all. It's a lot of it profit taking. Maybe people are kind of indicating like, okay, things are going to go back to some level of change or normalcy, or people not working in office, and therefore kind of exploring that. Dan, just to kind of tie off the Apple piece and rounding out the segment, I know last week we spoke about the M1 chip being put into the, I want to say the iPad, giving some more expansive opportunities for productivity. But I know you were not as bullish on, or I don't want to put words in your mouth, but that's what I surmised from talking with you last week, that you were not as bullish on their offering. Knowing that,
I like that they're using the M1 chip across their devices. Now, they're battling the same chip shortages everybody else is battling, but Tim Cook's background is logistics, so they're handling it as well as anybody. But that being said, my objection isn't so much putting it into the iPad. It's I'm not sure what the role of the iPad is anymore. Like the iPad Pro adds a keyboard and gives you sort of a laptop that doesn't work on your lap that I guess is useful on a plane or in a Starbucks. But to me, it's like, why would I pay $1,200 when I could buy a $1,000 MacBook Air? That device makes little sense to me, because I have an iPad mini and I used to travel with it and I'd watch movies on it. But now the resolution on my phone, and frankly, the size of my phone screen, I don't even have the biggest one, is so good that I'm not sure what the place of an iPad would be. I mean, my mother uses an iPad almost exclusively because she doesn't do a lot of computational things. She's, playing card games and checking Facebook and Instagram. So I see like a niche for it, but I don't get this like business guy who's traveling and doesn't bring a laptop. Like obviously sales are good, so I'm wrong, but I think that the trend is away from tablets, in my opinion.
Yeah, it's going to be interesting to see, and I think the short term doesn't make sense. Long term, where are they headed? Obviously, they got some good news this quarter. Will it be sustainable? So it looks like the market not necessarily always rewarding good news, at least in the short run. Dan Klein, we're going to leave it there. Excellent analysis. Hope you have a great weekend. Hope you stay nice and cool. You find that zen. You have a good, relaxing weekend, my friend. Take care. Talk to you very soon.
Thanks for having me, Jeff.
Bye. Well, that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter in the Morning Pulse, and of course, our website. We're back again tomorrow for BRN AM. We've got another great special guest. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.